Hey there, everyone. Welcome to our latest episode of the Market Misbehavior podcast. My name is Dave Keller. I'm the president and chief strategist at Sierra Alpha Research, the founder of Market Misbehavior. Thrilled to bring you another great conversation with a top market practitioner. Our goal with the Market Misbehavior podcast is to speak to people trading, investing, strategizing about the financial markets, authors, educators, money managers, anyone that we think has a compelling story to tell so we can learn some of their lessons that they've experienced over their successful careers, what makes them tick, how they define their investment approach, and hopefully some great stories along the way. And today, a fantastic guest to share with you, Bob Pisani. Bob recently stepped away from the New York Stock Exchange after 30 plus years as a CNBC Senior Markets Correspondent. He actually, as you'll learn from our conversation, if you didn't know, he started at CNBC in 1990 as a real estate reporter, eventually transferred over to the floor of the New York Stock Exchange in the late 90s, was there for the the rise of the tech bubble, the burst of the tech bubble, 9/11, the great financial crisis, everything else in the interim periods. Bob was on the floor. For many of us, our early experiences looking at CNBC as we learned about investing and charts and technical analysis were really marked by seeing Bob Pisani report from the floor of the New York Stock Exchange. I was introduced to Bob years ago by our mutual friend Jay Woods, who's one of the executive floor governors on the New York Stock Exchange, and I was super excited that Bob was willing to come on the podcast today and share with us some of his experiences. A lot of what I asked him, we're sort of teasing out some of the great comments and insights in his book, Shut Up and Keep Talking. At the end, I asked him exactly what that title means. Make sure you stay on for the whole interview because it's a great story about the challenges, I think, of financial journalism. But through the course of our conversation, we talked a lot about market misbehavior, right? About market and really investor misbehavior. Bob and I feel like are kindred spirits in terms of understanding the role of behavior, how emotions really drive investing decisions. And that was true, in the early 90s when stocks are trading on eighths, all the way to 2020s when stocks are trading to sub-penny, decimals. It's still driven by human nature and human behavior and investors acting irrationally. And Bob, I think, shared some really good stories about that through the course of his career. We talked about how the market structure has evolved so much, how the practice of trading with the New York Stock Exchange, how that has evolved over his time spent almost every day reporting from the floor. Active versus passive investing, the rise in passive investing. We'll talk about, John Bogle. We'll talk about index investing and active versus passive and diversification. Some of the lessons Bob learned from a number of conversations over the year with the great Jack Bogle. Overall, a really fun conversation. Someone whose face and voice you will probably find very familiar if you've watched CNBC over the years. I certainly did, and it was so much fun asking Bob some questions to dig into some of those great stories that I knew he would be more than willing to share. So please enjoy this fun conversation with author, journalist, and market practitioner Bob Pisani. So I'm super excited to be sitting down with Bob Pisani. Bob, you're one of those people I think for so many have become synonymous with the equity markets, with the New York Stock Exchange, with our experience as investors has somehow involved you on the camera at some point. So first off, welcome and thanks so much for all you've done to illuminate the markets for so many of us.
Thank you, David. It's been 35 years at CNBC. I was sort of the last of the Mohicans. I was the last person still on the air from the first year. I was hired in the summer of 1990. We went on the air in 1989. And it was a very, very different world then. Cable was in its infancy. There was not much in the way of competition. We had another competitor, FNN, that was around. We had bought them out. We were buying them out when I was doing that. And it sort of changed investing. We rode that whole, three things happened. Number one, all of a sudden, people had the opportunity to invest at home by very primitive systems where they could, like DLJ Direct, where they could buy stocks at home without going through their broker and calling them up. Number two, we had a shiny new object called the internet that happened. And I remember very well 1995, the Netscape browser August 95. That sort of changed everything. All of a
Yeah.
sudden, there was something to invest in directly attributable to the internet. And finally, there was a place to talk about it, CNBC. And we rode that whole wave, the new investing wave, the invested home wave, the internet wave. And we went from almost no ratings in 1990 when I was hired. And I know because I saw the ratings to being superstars by the end of the 1990. We were the hottest things on television. So it was like the greatest 10-year run of all time. And I always say to everybody, I hope somebody, you young people I talk to, I hope there's a point in your life where the wind is at your back. And
Right.
The bottom line is, I hope you're humble enough to realize it's probably not because you're a genius. It's probably because you're lucky enough to be at the right spot at the right time. And I was lucky to be there at that wonderful.
There's an investment, a little nugget of investment wisdom in there too, right? The balance between skill and luck, right? It's not just about being a skillful investor. There's a luck aspect to it as well, right?
Yes. Well, the great thing about long-term investing is if it's long enough, it doesn't really matter when you particularly get in. In my particular situation here, it really did matter because by, again, a little bit of luck, my father and I were teaching real estate at the Wharton School. I grew up in the real estate business. And the book came out the week CNBC went on the air. I mean, literally the week, April '89. And they had us on as guest, my father initially, and then they had me back. And eventually they hired me as the real estate correspondent in 1990. And I was the real estate correspondent from 90 to 96, became stock correspondent in 97 and went to the floor of the New York Stock Exchange where I was all those years. So there was a little bit of luck there, really, in terms of the timing. But I always tell people, you're not a leaf blowing around in the wind. It doesn't mean that life is entirely lucky. I saw that opportunity. I went after it, and through persistence and hard work, made something out of it. But I never shied away from the fact that I was extraordinarily lucky that I was there at that moment when CNBC went on the air. My best friend got one of the first jobs as a producer. She was working here in Philadelphia, and it was a big thing. And I don't know if I would have known her, I would have gotten that job. So there's that serendipity. It's that old story about the elevator. You walk into the elevator, you meet the girl you're going to marry. You don't know that, but there she is. And you walk into the elevator, there's a different girl. Where, heaven knows, I would have had a different friend, or I would have had a different book out at the time. It might not have happened.
I would assume 100% that in your successful career, Bob, there's been some great balances of great opportunities that have came up, but also your ability to pursue those and set yourself up to find success. I would think so. I hadn't realized that you had started as the real estate correspondent. I graduated from college and started in the industry in June of 2000. So I kind of knew you from that period on when I watched you on the floor of the New York Stock Exchange until CNBC did that really cool mashup of some of your early stuff. This was one of your, I think, their nice send off, which was awesome to see. When you were starting there in the early 90s, obviously CNBC financial media was a completely different thing. And by the late 90s, it was, as you mentioned, incredibly successful. And now it's continued to evolve since. Was there any sense that you had in those early days when you're covering real estate for CNBC that it was going to turn into this? Like, were there early signals that something was going to happen? Or was there a point, maybe in line with the markets, where the market rally where you thought, okay, this is actually going to turn into something way bigger than we realized?
What changed everything was really the Netscape browser in August of 95, because we had been talking about the internet already, and people were able to invest online. It's hard to describe what it was like investing online in like 1993 or 94. You had platforms like Schwab, DLJ Direct, where you could put in an order to buy Microsoft, 100 shares of Microsoft, but it might take 20 minutes to the next day to get a confirmation. I mean, literally, there were all sorts of problems. And today, people think it's a divine right. You get a sub-second confirmation. You buy 100 shares. Back then, that wasn't the case. It was a little bit rickety, but you could do it. And you didn't have to call your broker. That was revolutionary. And the problem was, and this was the same problem people had sort of with Bitcoin, was what is around to actually invest in that's directly attributable to this. So you could say, well, you had later on the Pets.com thing, but that was really much later in the 1990s. In terms of like what's the infrastructure around the internet, it was very hard to do until you got to the Netscape browser, and all of a sudden that thing just blew up, and our ratings changed. We all of a sudden started getting significant ratings in 1995, and that again that was sort of a turning point for us, because the public, gets excited about the chance. All of a sudden, when people hear that stuff is moving really fast, the get rich quick crowd, they're always there. We talk about long-term investing, and you and I have been doing this for a long, long time. But the fact is, what animates people, the get rich quick crowd gets very animated very quickly. And we saw that. All of a sudden, people were flocking, saying, wow, what is this? People like, it's just moving. Stuff's moving really fast. The same today that happens with some of this.
I was going to say, what you're describing could be a mid-2020s kind of discussion too. There's a lot of similarities, I feel like.
The key thing that you realize, and of course, David, I know, talk a lot about behavioral economics, thank goodness, because it changed my life when I started understanding in the 1990s how it does affect things. When we met Robert Shiller, who won the Nobel Prize in economics for largely behavioral economics research, he'd already, it was just the late 90s when I met him, he had already in the 80s published research indicating that the stock market was far more volatile than you would expect if people were completely rational actors. In other words, there is a relationship between earnings, dividends, and stock prices. The stock market, a stock is a promise on a future stream of earnings and dividends, essentially. And in theory, the stock market should have a certain level of volatility based on the earnings expectations. What he found was actually it's more volatile than you would expect. And he deduced, I think correctly, that there was a slightly irrational component to investing that was causing this excess volatility. And that was sort of the birth of behavioral economics, when people started saying, it's not completely homo economicus, where people always buy low and sell high. There are rational components. And when you understand that, you get a little more humble about, perfectly predicting the stock market, which is one of the reasons it's so hard to do.
Schiller's work, foundational for behavioral economics, right? And along with like Kahneman, Tversky, like some of these, incredibly, popular behavioral finance experts have really helped, I feel like, to open up the eyes of a lot of investors to what I feel like so many probably traders have seen day in, day out, which is people invest, on emotion, and they overreact, and they get nervous, and they panic, and they get excited, and that's reflected in the markets. 100% agree with you, Bob. I'm curious. Obviously, you have been covering the markets closely during an incredible period of evolution, from how markets traded in 1990 to how they're being traded in 2025. I'm curious, particularly with the behavioral aspect that you mentioned, how would you describe the behavior of the markets evolving from when you first kind of covered in the floor and 20 odd years ago to where we're at now? Like, how has that evolved?
You can make all sorts of subtle comments about this. And so, for example, we've gone from floor trading to electronic trading and decimalization. That has allowed much faster trading. People can react on their emotions much faster. We've seen at the same time, though, the growth of passive investing and ETFs, people investing essentially in indexes, saying that it's stupid to try to beat the markets. This came out of behavioral economics research. And finally, just the development of behavioral finance. I could talk about all these things in detail, but the one thing you need to bear in mind is things haven't changed that much. They really haven't. And the reason things haven't changed that much is that the emotions that motivate men and women, love, fear, greed, hate, lust, have not changed since the days of Caesar. And as long as those emotions and motivations don't change, then you can create new technologies around how to get greedier if you want, but the greed is still there, you see. Now, if suddenly we develop we all turn into AIs and eliminate the concept of greed and fear and replace it with something else, I don't know, well, then I would say things are really, really different. But I don't see things that much different. I don't see the behavior of people chasing Bitcoin or chasing meme stocks today any different than what I saw in the 1990s with pets.com craze. Now, you might say, oh, pets.com didn't have much fundamentals behind it. Yeah, well, there's not a lot of fundamentals behind some of this meme chasing these days either. So I can talk about how things have changed in terms of the trading patterns and styles and what's available to trade. But just remember, the fundamental emotions are not changed at all.
I love it. Human nature seems pretty constant, right? And we've seen that even this year we've seen panic, we've seen euphoria. Just in the last 6 months, we've seen all of those, I feel like, play out beautifully in the markets.
And what you need to do here is sort of stick to what I call them the key investing takeaways. This is the stuff that Jack Bogle from Vanguard, who was probably the biggest influence on me ever in the 90s, kept pounding away at me. He was very unhappy with CNBC in the 90s. But his main thing was, we can talk about it if you want, but compounding returns, very small differences in returns make a big difference. He said, Mr. Pisani, can you explain to your viewers what the difference between a 7% return and it's an 8% return is over 30 years? It's enormous. And he was right. Like that's the one thing I keep showing people. Here's a chart of a 7% return, 8% return. It's big numbers over a long period of time changes. That's one, compounding. Keep costs low by owning index fund. Two, three, don't try to time the markets. And 4, diversification reduces risk. I have basically, my entire career is based on these 4 precepts, and I just keep recycling them in new ways, in new situations to say the same thing. But I don't have any reason to change that. In 1997, I called Jack Bogle when I got the job on the floor to be stocks. I switched from real estate to stocks correspondent. The first guy I called was Jack Bogle, and he was just retiring at Vanguard. Brennan was becoming the chairman at that time, and I got him on the phone. I was surprised, and he said, "I said hi. I'm the stocks correspondent for CNBC. Just wanted to say hi, and maybe we could talk some more." And he said, "Well, I thank you for calling, Mr. Pisani." He was very professorial, not nasty, but professorial.
Okay.
And I just want you to know, I'm not very happy with some of the things I'm seeing on your television station. He called it a television station.
Nice.
Now, for example, these people you have on, you're trying to make superstars of these people. This Bill Miller fellow, Bill Miller from Lake Mason, this fellow you keep having on because you think he has an incredible track record. Nice fellow, but you do understand it's not going to last, don't you, Mr. Pisani? You understand that, right? I said, well, what do you mean? He said, well, do you know what the word persistence means, Mr. Pisani? I said, well, it probably means that they're going to have a lucky streak, but it's not going to last. He said, well, yes, basically. All of these people, you're dealing with thousands and thousands of analysts and strategists, and all of a sudden you pick out a half a dozen that have been fortunate enough to be right 3 years in a row, and somehow you think that they're geniuses, when in fact they're just having mathematical probabilities of being successful. There's going to be some, and it's not going to last. Those dozen that you pick out that you think are successful in the last 3 years are not going to be the ones who are going to be successful in the next 3 years. That's persistence, Mr. Pisani. Now, why don't I hear more about that and more about long-term investing instead of people trying to pick stocks? So it went on like that. And at the end of it, he said, no, I'm going to tell you what, Mr. Pisani, I'm going to give you my phone number, my direct phone number, and I'm going to give you a fellow who I work with. Gus Sauter was his name. And you call me more often now, and we could chat a little bit more, but I'd like to hear a little bit more about index investing, long-term investing, and a little less about these superstars you're trying to create on your television. And that started a 12-year relationship with him. And I hung up and I called my wife. I said, this guy in Bogle, he's right. I mean, really trying to pick stocks persistently. Even then, 7 years into my career in 1997, I could see he wasn't going to make it. And I said, we should open account. And I did. My wife opened a Vanguard account in 1997, and she's now semi-retired real estate agent for 38 years and lives off some of the income that Jack Bogle helped her on in 1990. So there I am. I'm one of the things that I don't know about you, David, but I publish what I own. In the book, I have a major problem with people going around saying, oh, this is what I think the market should be doing, blah, blah, blah. Nobody ever says, so you're so damn smart, they put your ugly face on TV. What do you own? And I publish it. I tell people, and not surprisingly, it's the core holding is an S&P 500 fund. So
well, and that's the reality of it, right? Is that Vanguard account you opened in 1997 to 2025, pretty decent performance overall, right? With some challenging periods along the way, but overall that was not a bad place to be during that period. I would say.
Look, it wasn't a bad place to be. Look, the basic concept here: keep costs low by owning index funds. And again, this is a big Bogle thing. He kept screaming at me, Mr. Pisani, the difference between a 1.5% fee and a 0.5% fee is a full percent, and you should show people that what the costs are over 20 or 30 years of giving up that extra percent to somebody. Because at that time in the 1990s, it wasn't unusual to have fund managers charge 2%. Now, today, the typical fees are below 1%. And, you can buy a Vanguard, you can buy an S&P index fund for 3 basis points. But back then, it was quite remarkable. The money they were charging. And so essentially, people were giving up huge amounts of income. And he railed against that. And he was absolutely right. His other big thing was about timing the markets. And he used to show me these things about, well, here you go, Mr. Pisani. Here's $10,000 invested 20 years ago. And if you wouldn't have been in the market on the top 10 days, you would have had significantly less amount of money. And you've seen this, David, these numbers where you can slice and dice the market in any way. But if you're not in the market on certain key days, your total return is dramatically different over long periods of time. And you can do it in any direction, any way. And the problem is nobody knows when those 10 days are, or those 20 days are, or the 10 worst or 20 worst. So the only rational thing to do is to stay in the market, have a plan, and understand what kind of risk tolerance you have. What is your age? So let's be personal. I'm 70 years old. I believe I will live another 20 years. Now, I'm probably wrong. My actuarial friends say I should be working on 95, but let's say 20 years. 20 years is a long time. That means that I'm not terribly worried about this year. I am almost 75% stocks, bonds, 72% now stocks, 22% bonds, 4 or 5%, 6% maybe money market funds. So, I tell people exactly what I'm doing. And a lot of people, I've never owned gold, but I understand why. I think gold is a perfectly rational investment for a lot of people. Gold satisfies a lot of needs. It's an alternative investment. It has been money. I've had back and forths about Bitcoin with people for a long time. I understand in certain circumstances the use case. I have a problem with some of the philosophy behind it, and a lot of it is largely get-rich-quick schemes. I don't think this is the proper place to discuss that. But the bottom line is people need to simply understand what their age is. If you're 35 years old, you will likely live another 60 years. That is a long time. And people say, well, what do you think the market's doing now? I said, look, you can talk about it if you want, but it's a philosophical exercise. At 35 years old, you shouldn't worry about it. Well, is this the right time to get in? The market's very expensive now. You're 35 years old. It's not. You don't need to worry about whether this is the right time. What do you think you're going to know that the market's going to drop 10%? You have no idea. But you're going to live another 60 years. It's not going to matter to you if you get in now versus wait another 3 months. Do it now and don't worry about it. And have a plan for regular investing and understand what your risk tolerance is. If you can't stand the idea that 50% of your 401k is in stocks, and it makes you nervous, then go down to 40%. But for heaven's sake, don't keep pulling money out and putting money back in. That is a recipe for disaster. And you know that. You cannot make any money by pulling out. You think you know how to market time, and you don't. You give that up. Once you give that up, you're freed intellectually from worrying about things. Stay with the plan. If it's a plan of only 30% stocks, then fine, stay with that. But don't make it 40, and then make it 40, and then make it 80. If you know how to do a P&L, you're going to find you're going to lose. You're going to underperform the market. The game is to stay with the market.
Yeah, younger investors, particularly non-investing types who are doing other things and just casually looking at the markets when they ask me about what they should be doing, my comment to them is, your biggest advantage is the amount of runway you have in front of you. You got a long time to be in the market. So start early and get money in there, and then just try not to touch it as much as possible.
And this was the big mistake my generation made. I am the classic baby boomer. We were terrible. In the 1970s, my father tried to get me to invest in the stock market, and I ignored him. I mean, I hitchhiked around Europe. I was a hippie. I was a deadhead. And we had a great time, believe me, I think, in the 70s. But we didn't save any money. And as a result of this, the baby boomers do not have a tremendous savings rate overall. I was 35 when I got the job at CNBC. I'm now 70. So this was 35 years ago. And when I got the job, I was married 5 years and essentially had no money saved at all. I had a small amount of savings account, but I had no 401k. I had nothing at 35 years old. So I lost essentially 10 years. And this compounding interest idea is really important because that's a huge amount to have lost, a huge amount.
Yeah.
I regret that. I regret ignoring my father.
I've talked a lot with friends in the industry about when you start investing and how that affects your thinking probably through your entire career. And you described with baby boomers, 100%, right? If you sort of your initial investing period is the 1970s, which was a secular bear market with a generational low right in the middle. That's a pretty tough time to sort and equities were not sexy at that point, right? I mean, equities were pretty boring and sleepy and dead part of the industry for a lot of years. I've had a similar, I mean, I'm the next generation down probably, right? So I started in 2000. So my first, 10 years as an investor were 9/11, the great financial crisis, not a great time to grow equity assets. And so I fought that the whole period, like 2010 on, has been fighting my natural urge to be skeptical of the market going higher. And I think the thing that saved me is by exhaustively studying market history. And you see how rare it is that you have those sideways to down periods. And as you write about in your book, right? I mean, the average move is higher, right? Generally speaking, equities are kind of moving higher. I'd love for you, Bob, if you could, to share. I mean, you've had that unique benefit of being on the floor of the New York Stock Exchange, and I know the floor certainly has evolved since you've been there. But can you talk to me a little bit about some of those periods where fear was probably palpable, right? Things around like 2001, 2002, 2008, 2009, where it felt to the investing community like the world was ending for the markets. What is that experience like on the floor of the exchange? Is it really, do you feel panic? Do you feel nervousness? Do people have ice in their veins in those sorts of phases? What is that like?
All of that. The world's very different now. And when I got there in 1996, 97, there were 4,000 people on the floor of the New York Stock Exchange. 4,000. It was a city, and it was like a private club. It was a private club. It was a mutual organization. The members, seat holders, owned the NYSE. And because of that, people on the floor, it was very much more human thing. I mean, what I witnessed was the slow birth of electronic trading and decimalization. So at the time when I got there in 96, they were trading in eighths. The minimum increment, an eighth of a dollar. Imagine how profitable this business was, an eighth of a dollar. In 97, it went to a 16th, which is 6 1/4 cents. And then it went to a penny in 2000. So the profitability of the business kind of collapsed in that time period. And I saw that happen. But about panic, Art Cashin, who was sort of my mentor when I was down there, he was trading at UPS, floor trading, wonderful man, passed away in December. Used to say that you could hear the emotions on the floor when strong selling waves came in. You could hear the shouting increase. You could hear the clacking of the machines with the orders in the back in the 60s even. And yes, you could feel it on the floor. I would say the bottom of my 35 years at CNBC, the worst moment was immediately after 9/11, and because that was a very palpable physical thing. That was right down the street from us. I was under one of the buildings when the second plane hit, and believe me, you see when that first plane hit, I was coming into work, and I ran towards the building because we thought it was a plane accidentally had hit. And the second plane hit, I was right under the building. And man, when that plane hit, 10,000 people standing outside gasped. You could hear like a gigantic collective, like the air went out of the whole neighborhood, and people all of a sudden, plane debris started landing around people, and that panic, boy, I'll never forget that mass panic. When something like that happens and you're in the middle of it, you don't forget it, because you're not going to turn around and say to somebody, okay, just calm down, you're running me over. Everybody, you're not, because if you stop, you're going to get run over.
Yeah.
And you really just kind of keep moving along with the whole thing. So the floor was in a state of depression because 5 of my friends were dead and everyone had friends who had died. It smelled terrible for a year and a half. I mean, just smell of death, basically.
Yeah.
And we were in a recession and there was concerns about another terrorist attack. And it affected everybody emotionally and mentally on the floor. And it affected me. And I was thinking of leaving. I said, this is it. It's been 10 years, a good run. And what I did was I learned to meditate. I know this sounds corny, but I joined the Buddhist Meditation Society. And I'd always been interested in meditation. And it taught me, I spent 6 months learning, like literally going to school after work. And it taught me that things had happened, that it was not my fault. I had nothing to do with any of this, that life is change, and that you have to be able to adapt. And at the end of it, I calmed down, basically. And I realized that I still liked the job, and I re-signed my contract at the end of it. But that was emotionally sort of the toughest time for everyone. And a lot of people quietly left after that. Again, we were going to electronic trading anyhow, but that was a major part. The other thing, 2008, 2009, was a more generic disaster, because what happened then was my entire generation, the baby boomers, essentially flushed a lot of their savings down the toilet. And that was really hard to take, because it wasn't just stocks. People, that's when I really became a diehard behavioral economics guy, because people don't buy low and sell high. There was massive selling of the market, even at the bottom. Yes. I followed a few mutual fund, sales and buys every month. And you'd think like, in 2007, it started dropping from the bottom, as you know, David, to the top to the bottom. The S&P dropped 50%.
That's right.
And a half till March 2009. And you would think at the bottom in March 2009, down 50%, you don't buy, you don't sell, you buy. Any rational person would think, unless you think the economy is going to zero and we're living in mud huts, you don't sell. But they were. And
everyone was.
I did a story on this for my Trader Talk blog in 2009, saying it is amazing. Look, the people are still selling with 50% down. It made no economic sense. It happened in the real estate market too. People sold their second homes for pennies, for nothing. And so I remember being really depressed in 2009, saying, "Oh my God, we're never going to recover from this." I mean, my generation of wealth is is significantly reduced, and it took years emotionally for people to sort of get over it. Fortunately, by 2010, the stock market was slowly turning around, but it took a long time, and it had a lot of consequences. The great financial crisis in terms of investing, it dramatically accelerated index investing and ETFs, because a lot of people came back and said, "Look at all this stupid, irrational behavior and what happened in the markets." I mean, it seems like the best thing to do is not to try to pick stocks. The best thing to do is just stay with the market and have a plan, like we just said. I mean, everybody, that was the basic rule here. And it accelerated investing in ETFs and index funds, which was one of the only few really good things that came out of the great financial crisis, in my opinion.
No, Bob, thanks so much for sharing some personal stories there along the way. And I think for so many of us, we were in New York during 9/11, and obviously a really challenging period. You lose friends, colleagues, clients. That was tough. But I feel like the days, the months, the years after, I felt incredibly proud to be a New Yorker, because you saw people come together in some really awesome ways. And I'm sure you saw that on the floor of the New York Stock Exchange. I know Jay Woods, a mutual friend of ours, has mentioned that many times. And I think with the financial crisis as well, hopefully people, coming out of these sorts of things, find meditation, find life improvements. So I hope people can think about that.
There's a whole chapter in my book about what meditation did for me. I still meditate. I wish I could say I've attained some Buddha-like state of calm. After 25 years, I sort of call myself a failed meditator. I can intellectually explain the benefits of what it does for you, but emotionally, I still get very emotionally involved in things. I wish I could, attain this Buddha-like calm that I know is out there somewhere, and I can describe it, but I'm not there. I keep trying.
You are still in a New Yorker, I think, mentally, right? I mean, there's only so much meditation, mindfulness we can have in certain environments, but No, I think that's great. Hey, listen, to wrap up, Bob, your book is fantastic. This came out, 2 years ago, and it's been one of my favorites. I hope this is the first of a number of books that you're able to produce, because it was just really entertaining. A lot of great anecdotes, people you'd met and spoken to. The title of the book is "Shut Up and Keep Talking." Can you share with us that story? Because I love. I mean, it's a beautiful title, but I think really speaks.
I don't know. Those of you who are thinking of writing a book, my advice is don't. They don't make any economic sense. It's my second book, and believe me, I wrote an article for CNBC when the book came out saying, thinking of writing a book, you might want to reconsider about how ridiculous the economics of it are. But when I was publishing the book, the publisher, Harriman House, great publisher in London, the guy who's the lead editor called me and said, well, we need a title. We bought your book. We need a title. I said, well, I want to call it Lessons on Life and Investing from the Floor of the New York Stock Exchange, because that's what it is. It's a summary of my career and what I think works and doesn't work for investing. He said, no, that's a subtitle. Yeah. What, Lessons on Life and Investing from the Floor of the New York Stock Exchange. We need a title. We need something catchy.
We need a hook.
You're on TV all day, right? I said, yep. And he said, okay, when you're waiting to go on the air, what does the producer say to you or the director? And I said, well, the producer will get on my ear. I have an IFB. It's a good hooks into my ear. I have a microphone, do two wireless ones on one side. One's a microphone, one's hooked into my ear. Yeah. And the producer will come on and say, hi, Bob, you're up next. Carl is tossing to you. Talk back to David Faber, Jim, somebody like that. And he said, okay. And then what happened? I said, well, I talk for usually, 3, 4, 5 minutes, something like that. And then the producer will tell me to stop. And usually they'll say wrap. Wrap means shut up in producer talk. Or sometimes they will say stretch. Stretch means keep talking. Yeah. So a TV reporter will spend most of their career hearing some variation on shut up and keep talking. And he said, that's it. That's the title. Shut up and keep talking. Now you're going to have to explain what you meant there, but do that in the introduction.
I love it. Oh, it's well done. Listen, Bob, this has been a pleasure. I hope we can reconnect again. I wish you much success with this next phase as you move on from being on the floor of the New York Stock Exchange. I hope you have the opportunity to meditate and travel and enjoy all of that life has to offer. But for now, I will say thank you for being, part of the investing experience for so many of us. And thanks for sharing some thoughts today.
Thank you, David. And I'm not going anywhere. I'll probably be on Substack and probably will be back at CNBC as some kind of consultant and contributor. And in the meantime, I'll be doing some traveling and maybe some lecturing and some public speaking. You find out more on my my LinkedIn page, Bob Pisani. So thank you, David, for having me.
For sure. Thanks again, Bob.
All right. Take care.
It's so interesting. Bob and I talked, for a little while off camera when we weren't hitting record about a number of different things about the industry, about financial media, about how it's all evolved. I'm super excited that Bob is, we talked about how he, literally had been reporting from the floor for 30 odd years. And so, he was super excited at this stage in his career to sort of get away from the New York Stock Exchange, to travel, to speak, to write. And I am super hopeful that Bob, shares more and more of that investment wisdom that he's built up from conversations with, investing legends that he's been able to connect with over the years. I love his, his summarization of Jack Bogle's approach, right? Compound interest and the importance of that, keeping your costs low, right? Doing the due diligence there, the challenges of timing the markets and how it's often a fool's errand, and diversification and your ability to navigate through different periods by diversifying appropriately. I feel like so many investors could just stick to those 4 nuggets of wisdom and probably do a lot better than they would otherwise. We also talked about the approach that he uses in his own portfolio and that I use in my portfolio. For me, it's the core and explore model, where you have a core position, which is really more passive, but then you have an explore position, which is smaller, a portion of your portfolio, which is smaller, but allows you to take, different risks and take more concentrated bets. That balance for me has allowed me to overall grow a portfolio over time, but do so in a way that really resonates with me as an investor and as a market practitioner. So I'd encourage you to really, think about some of the lessons that Bogle, who is very much an advocate, of course, of passive investing, think about how you can, I think there's too much of a active or passive debate. And I think it should be active plus passive and combining them in meaningful ways. That's how I've found some symmetry in my own portfolio. I hope you're able to find that as well. Really enjoyed speaking with Bob. I'd only met him casually and briefly before, so it was really fun to be able to ask him some deeper questions. And I really appreciate Bob's willingness to share some great stories with us here today. As Bob mentioned, he's in the process of sort of ramping up to this next phase in his own career. You can find more information about what Bob is doing on his LinkedIn page and also bobpisani.com. Hopefully coming very soon. You'll be able to check things out there as well. That's it for today's episode. Hey, if you want to learn more about that balance between passive and active, how to, really think about the momentum that can drive a good passive strategy and the actionable ideas that can help inform your active strategy, our Market Misbehavior Premium memberships could be a really good opportunity for you to upgrade your own portfolio here in 2025 and beyond. 3 great benefits to the premium membership. First off, we'll teach you all I hope you need to know about behavioral biases, what happens in our brains, what happens between our ears, and why it's so hard to make good decisions in your portfolio sometime, but also technical analysis. There is hope, and it's a practical set of tools to help you better understand the world around you. I've found so many investors get into trouble just by not having the right information available and having the right routines to assess the market conditions. Second, you'll have access to our members-only reports, like our weekly flight plan, our main report, what we see as our most important work every week, where we look back at the week that just happened. What did we learn? We look forward at the week to come. What are we looking for? And by going through that process every week, I hope it helps you improve your market awareness. Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community. This is a safe space of like-minded investors where you can ask questions, where you can learn from others' investing journey, and hopefully get some good ideas as well. I'm in there every morning checking for questions, sharing insights, sharing charts, and just keeping the dialogue going. We'd love to have you join us there as well. For more information on our premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for watching and listening here for the Market Misbehavior podcast. I'm Dave Keller with Market Misbehavior, reminding you it is always a good time to own good charts.